We will be discussing differentiated hedge fund strategies in challenging macro environment, which we just discussed half an hour ago. The importance of diversified and non-correlated return streams. So we are not really longer show, we're trying to make alpha. We're trying to make money in any market conditions. It's important to point out that lots of hedge fund alpha is masquerading as beta, and the alphas of yesterday are today's smart beta. What are the alpha today that will commoditize into the future? That's also the topic we'll be discussing. And lastly, why have so many managers been falling, lagging the indices, and what strategies are most and least likely to benefit from Fed's pivot in interest rates? So lots of ground to cover here, but let's cut to the chase and start with Robert. What strategy do we currently deem favorable or less favorable, and why?
Excellent. Well, thanks very much, first, all of you, for being here. Obviously, to the Adapting team, who've done an excellent job. There are a couple of strategies that you can point to. One that I'll just touch on that maybe people aren't as aware, given that maybe a lot of you have institutional clients, or maybe you allocate on behalf of, let's say tax-free folks. But the tax-aware strategies are quite popular within our wealth channel right now. The firms that you might be familiar with, AQR, Gotham, and some others are doing a lot of work to try to find ways to offset either short-term capital gains or actually, believe it or not, long-term capital gains. So I would say right now, given the uncertainty, what's going on in Washington, the election obviously next week, there's so much happening that we're selling hundreds of millions of dollars a month in tax-aware, or some people call it tax-advantage strategies. In terms of a strategy that's probably not as popular, both on the macro side as well as within our channel, is really emerging markets. Not sure I personally agree with it, but I'm just speaking from a macro level, no pun intended, that ultimately, the dollar's been strong. EM should be a good place to go, but we haven't had any traction there. And ultimately, I think EM debt could be an interesting play. I think it's started to gain traction this year, but I would say with the uncertainty right now, it would be difficult for me to make a call beyond that.
Thanks. Moving to Jackie.
Thank you, Vidak. I want to give you a big thanks for inviting me today. I've attended many Beryl Elites conferences in the past, and I always look forward to it. So I really appreciate being on this panel, and to do so with colleagues in the industry who I know quite well. So thank you. Very exciting time in markets for so many different reasons now. With all the catalysts on the horizon, I mean, it is an election year. There's a change in monetary policy. Some things have worked out better than others, and there's a variety of different strategies that still are very exciting. Anything positively convex is probably going to do well, because any vol-friendly strategies, some things that come to mind. So our focus at PIMCO Prisma is hedge funds, so everything we do is hedge fund related. But hedge fund strategies that are vol-friendly, like global macro, should do well. Things that have a vol-friendly bias. There's things to do across divergent themes and monetary policies globally. It's not just going to be a long-only environment. People are questioning. We're coming off a year of a great 2023 equities, and then 2024 equity highs even more. So people get a little bit worried that how strong can earnings growth continue? Earnings growth might come in a little bit next year. There could be some multiple contraction. So people need to be able to play longs and shorts. And the reason I say strategies like a global macro is, like you saw what happened on August 5th. There was that, we all had this bad dream of that one-day move where Japanese equities hit a correction that we hadn't seen since 1987. VIX moved that week 45 points, which is the biggest weekly move we ever saw ever. Dollar yen getting crazy moves, crypto came off. It was just this very short-lived event. So to be able to express views long and short, there's a lot of alpha to generate. But other than just global macro, there's a lot of other strategies within equities that we're leaning into. We think that even within tech stocks, AI is still going to be a very long-term theme. There's going to be a lot of disruption and innovation across hardware, cloud computing. There's going to be winners and losers in the space. It's going to be an environment, good environment still for stock pickers. That doesn't seem to be something that's going to end anytime soon. Within healthcare, pharma, biotech, also very exciting area. pickup in M&A. There's some interest from large cap pharma acquiring some biotech technologies, and that looks like it's going to be something exciting. All the innovation and the benefits we've seen from those obesity, weight loss drugs, GLP-1 drugs, it's a huge game changer, and it's going to be expressing views and trades, within equity long short. It's going to be exciting. Within energy, it's not just about long energy, short energy. There's going to be a lot to do within dealing with decarbonization, green energy transition, trades within traditional energy and renewables and things like that. So within equities, there's going to be plenty of pockets and sectors that should do well. Right now, the market, everyone here, we have a longer term investment horizon. We have the elections next week. The market's clearly pricing in now a Trump victory, could be a Trump sweep. Most people think that regardless what happens with the outcome, equities are still going to continue to grind higher. There seems to be some complacency. Even across the election, the market's not really pricing in any shock events. Vol expiring for the election is trading implied vols around 2% for that daily move. A few weeks ago, it was like 3%. Back in 2020, it was 4%. So like right now, the market's not really too scared of election being much of a catalyst. But it's probably going to be, equities will grind higher, but there'll be plenty of opportunities to go long and short. And I think in some of those sectors should be some good alpha there.
Thanks, Jackie. Just next time when you speak, just close the mouth. Not from here. Ark, on this note, tell us about your
Sure. Is this close enough? First of all, again, thanks for the invitation. Lovely event. I love this stage. It's a very unique place to present. I'll maybe take a different tack in answering this question, thinking about what does it take to make a good hedge fund strategy? What makes hedge fund strategies attractive in a specific point in the cycle? And usually it's a collection of things. It's some sort of inefficiency, some sort of a moat, and then tradable opportunities. Trading opportunities emerge out of market volatility, out of uncertainty, out of a greater dispersion. And this year has been full of those, and frankly, we're obviously not yet done with the volatility that's coming potentially in the election cycle. Whichever way the outcomes pan out, certain sectors will do better than others. We are expecting to see a lot of dispersion in different sectors, different markets. That's what hedge funds, that's what alternative investing in general is for. It's capitalizing on those inefficiencies, capitalizing on market movements. So through that lens, Jackie stole some of my thunder, but we think discretionary macro certainly, because it's more of a forward-looking strategy and it's able to pick up opportunities not just in equities but across markets. Political events, changing interest rate cycles, different central bank behaviors, all of those are tradable events for discretionary macro in commodities and fixed income and currencies. The biggest area of growth for our business has been risk mitigation strategies. Macro is a component of that, but so is volatility trading. There's not too many things in traditional institutional investors' portfolios that will make them money in a sell-off. Whether you're looking at public equities, fixed income, long commodities, private equity, private credit, those are all long risk. Those are all pro-growth strategies. There's not a lot of stuff out there that can be anti-growth or serve as a hedge. So volatility strategies certainly can be that. And then if we talk about the flows in our industry in general, private markets, look, there's been a lot of popularity for a couple of years. It died down a little bit in 2022, but it's been coming back. We see that by the amount of capital that's being raised in traditional private markets and private equity, private credit, but also at the intersection of all of these markets, rescue finance, capital solutions, different sorts of restructurings, preparing for the next default cycle if it ever comes. So private markets definitely are getting a lot of attention for us and others.
Thanks, Ark. So pretty much it's okay to be correlated in up markets, but it's important not to be correlated in down markets. So Samuel, can you expand a little bit, perhaps lessons learned from LGT Capital, and also tell us about what works and what doesn't?
Sure, and thanks for having me also here on this great panel. in this unique location. So thanks for that. In terms of what we see as attractive or what works, I would second what was mentioned also in the previous panel in the sense of active management is back to some degree, because we have seen since COVID, volatility and dispersion has picked up, and we believe that this creates a lot of opportunities. And we believe, for example, systematic strategies have done pretty well over that time, be it on the macro side, be it on the quant equity side. And we believe that that will continue to be the case if we see still an uncertain environment with bouts of volatility, but still sort of underlying shifts. And then when we look at specific strategies, it's obviously great to go last because everyone already mentioned some things. But maybe to add another element, like this place, it has kind of a retro feel, but it's still very cool in this time. And we talk about AI, but it's still valid. And we believe still there are some strategies which are maybe also classic strategies, which still have a place today and which are actually quite attractive. So for example, we see ILS or reinsurance markets is kind of attractive at the moment. It has had a pretty difficult period from 2017 to 2022. Since then, we still see sort of a lot of catastrophe events in the world, and insured losses are going to be, again, over 100 billion this year. But we believe that from an investor perspective, a lot of things have improved. And actually, the rates going forward look quite attractive, and it's an uncorrelated return source. So that's something that we like. Also, convertible bonds, for example, also classic hedge fund strategies has seen a lot of shake-up. The index level returns haven't been that great. But when you kind of dig deeper into it, we believe that from the concentration in that segment, there's a few players who are actually in a very good position to sort of earn structural premia from kind of exchanges, as companies don't want to have their sort of convertible bonds mature, and also from new issuance, which is sort of picking up after the start. So we see kind of many areas where we like it, and also on the healthcare side, I would second that in the sense we have seen kind of sort of the slump in 21, 22, and now we kind of have this resurgent as a potential opportunity. For us, we don't try to sort of bet on that on a beta way, but we would rather look for specialists who are able to earn money from sort of this higher dispersion, but then also have the ability, if biotech is sort of coming back, to sort of dip a bit into that without having a huge tilt in that direction.